Here I'm giving you a portion of my new Accelerated Mentorship program, which includes close to 20 hours of trading instruction plus access to the weekly live classes. This video discusses brokers and what you need to know when opening up a trading account. If you'd like to join and learn more, visit DayTradeToWin.com, Accelerated Mentorship for more details. Let's discuss brokers and the role they play on our behalf when trading the markets. To trade with real money, a brokerage account is required. There's a bit of a process which involves certain requirements and responsibilities, so I'm going to help explain how this works, and hopefully when the time comes you won't be surprised with the rules and regulations involved. At this point in the program, we don't recommend you jumping into opening a brokerage account. It's really not necessary because there's no difference with the charting platform, the live data, placing trades, everything is the same and it's at your fingertips. Except it's not linked to real money. So the good thing is that everything you'll be learning and practicing is done without losing any money. Mistakes happen and they can be costly. So let's learn from those mistakes now instead of risking real money later. There's no difference and there's no cost to you. Opening a brokerage account has fees, including data fees, maintenance fees, and so on. When referring to your broker, we'll start off with what's called an introducing broker. Think of them like an agent. They are a firm that is responsible for executing the trades and responsibilities to follow the rules laid out by the exchanges. They have fees, so they work for you, they take a commission, and you should use them for questions and help you with anything that you need. With an introducing broker, the brokerage firm accepts your orders. They have risk involved because they have an arrangement, a duty to help maintain custody of your securities account. There's a second part to this, which is a bigger player called a clearing firm. They also have custody of customer accounts. Clearing firms, or carrying firms as sometimes they're called, must maintain a higher level of net capital than introducing firms, and they are responsible for segregating the customer funds and securities in their custody. Some clearing or carrying firms are also brokers. They can be both. In this case, they also handle your orders to buy and to sell securities on your behalf as the middlemen, following the rules set forth by the exchanges and the government. They also maintain custody of your securities and other assets like cash in your account. I'll give you an example with NinjaTrader Brokerage. When they first started, they were only an introducing broker, and they used a clearing firm like Dorman in order to maintain a higher level of insurance and security for their customers. Now, NinjaTrader Brokerage is also a clearing firm, so they're one and the same. Now, brokerage firms, whether it's a clearing firm or an introducing broker, they have fees associated with trading. So the type of fees that you should be focused on is the commission for the broker and the exchange fee directly. So we're going to talk about the Chicago Mercantile Exchange, or the CME, which is trading the E-mini, the crude oil, the Euro futures, NASDAQ futures. So the CME has exchange fees. They are nominal, probably a couple of cents, 5 cents per side. So it's not really a big deal with the exchange fees. They make a lot of money because there's thousands of contracts changing hands every day, so they make a few cents on each transaction. The brokerage fee is the big part because they make a couple of dollars each time you buy and each time you sell. So they calculate the fees for the brokers per side. So you pay a fee when you enter into the market and you pay a fee when you exit the market. Now really what that's called, if you say, what do you call a fee that you get in and you get out? Because obviously if you enter the market, you have to get out of the market. It's called a round turn. So when you talk to your broker, you should ask him, what is the fee for a round turn to buy or sell the E-mini or the NASDAQ or the crude oil? That way you'll know what it costs you on the brokerage side. Another term you should be familiar with is all in. So the term all in basically says what is the fee to get into the market, to get out of the market, and the exchange fees all wrapped up into a package. So if you want to take it a step further, just know the term all in. That means they're going to give you one price to buy one futures contract complete. The other fees you may have with your brokerage firm are maintenance fees. So monthly fees could be a couple of dollars a month to maintain an account. Sometimes it's free, sometimes they charge you a few dollars. Other fees you should know about are data fees. So a data feed from the exchange is that you're using their data in order to place trades, typically about $12 to $30 in data fees, depending on the type of data that you want. They break up the data into separate segments. So if you want futures, if you want stock, if you want different securities like currencies, sometimes they have a package together. For what we're doing, you should expect to pay about $12 in data fees. Now, the importance of communication and access. When it comes to calling your broker and asking him questions, or if there's a problem, you have to deal with a reputable brokerage firm that you're able to contact in case of emergency. If you have a brokerage firm with 3 people working and thousands of clients, it's impossible to get a hold of them. So just remember, whoever you decide to open a brokerage account with, make sure they have a good staff that you're able to communicate and have access to. Now, you can expect a nightly email or nightly report after the exchanges have closed. They do what's called reconciliation, where they look at all the trades you've done, they calculate the commissions and the fees, and they send you a statement, a nightly statement. After the reconciliation is done, you can log into your account and see the fees, the trades that you placed. More importantly, look to see if there's errors, because errors do occur. Sometimes you may be able to get a credit for those errors. Sometimes the credit just comes on automatically and they say, we made a mistake, we're crediting your account. That does occur. So pay attention to see if you see or catch any errors for trades that you may or may not have taken. It's rare that that happens, but obviously errors do occur. Now, when it comes to margin, this is a bit of a confusing issue because margin depends on the market or the security or the instrument. It depends on the day session or night session, and it also depends on your broker. So a clearing firm has a much higher level of capital, and they can offer lower trading margins. And so what margin is comes down to the amount of money you have to have in your account to be able to trade one contract. As an example, currently, to trade one E-mini S&P, you need $500 in your account. So if you have $1,000 in your account, you could trade 2 E-mini S&Ps. Now, I don't recommend anyone trading on margin, which is the absolute minimum you need, because if you have a losing trade or if the market goes against you, you can be in trouble. So that's not really what we do here. But you should be aware of how margin works. There's a difference between the day session versus the night session. You need currently $12,500 to hold a position overnight, like a swing trade. If you wanted to trade one E-mini S&P, if you just wanted to enter and exit as many times as you wanted during the day, during what's called the day session or the pit session, then it's just $500 per contract. Currently, that's the going rate. But margins do change, and they change based on volatility. Recently, we had a lot of volatility, and they increased the margin because it's so easy to lose $500 in a matter of, let's say, minutes, because the market is moving so strong and so fast that they had to increase the margin in order to protect themselves and to protect you as well, because obviously if the market goes against you very hard and very strong and you don't get out of the trade, it's possible that you could wind up owing money to the brokerage firm. So they have to be well capitalized and insured in case something like that happens. And that's really the reason why they want people to have margin requirements, so that doesn't happen. Just remember that. Try not to hold a position after 4 p.m. Eastern time, because at that point we get into kind of a lull area into the overnight, and if you don't get out of the market by that time, you may be forced out or you may pay a penalty for holding a position overnight. There are some tax advantages for traders. Now, before I go into these tax advantages, we have to say this disclaimer that we're not accountants, we're not licensed accountants, we're not licensed to give you tax advice. So whatever I'm going to mention right now and right here is just for you to know and for you to really ask your accountant more information on. That being said, if you have any expenses associated with trading, It could be a new computer, it could be research, it could be the data fees, it could be the commissions, it could be licensing, it could be whatever. So if you have any expenses, this program that you purchased, you can claim that on your taxes as an expense towards your trading business. Now, to have a trading business, it's not necessary to have an LLC, but I always recommend that if you are going to dive deeper into this, and in good time, obviously, let's not jump into opening up a new LLC right away. If you have an LLC, you can claim this as an expense, and you can also claim it as an expense on your taxes. So that may be a benefit for traders. So remember, whatever expenses you may have, whether it's the cost of educational program, whether it's the exchange fees, the brokerage fees, a home office, remember to ask your accountant if those can be deducted correctly as part of your trading business. Now, you do have reduced fees available. You should ask your broker to see how many contracts minimum you have to trade to get those reduced fees on a monthly basis. They even have at the CME exchange what's called a high volatility discount. So if you trade a lot of contracts, you're able to get a reduced rate on the fees from the exchange. So definitely ask your broker to see what that minimum requirement is. Maybe 100 contracts a month. It may be more, it may be less, depending on the broker. Because remember, they're making money on your commission. So they want you to trade more, and they'll reduce the fees at the same time. Now, I've covered here the basics for broker's fees and margin and a few other things. And it's been like this for a few years. I don't anticipate things changing that much, but things can change. Margin can change. Different markets like crypto now are available with different exchanges. So things are always changing, but you still have to open up a brokerage account to trade real money. There's an application process similar to opening up a credit card account. So it's not too complicated, but these are the steps required. These are the players involved, and these are the fees that you can expect. But above all, refer to your broker with any questions you may have. They're licensed and they're there to help you. If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.